Yes, you're welcome back from the short break. Let's proceed from where we stopped. Yeah, we have talked about the the maintenance of capital accounts using fixed capital balance method and fluctuating balance method. So with the fixed capital balance method, we have said you open a capital account in that format. Then you open a current account. The current account, I told you, it is an account that records the transactions between the partners and the business. It will have a balance brought forward because it is capital. You know, capital has a credit balance, so we normally put balance brought forward this side. Then, if there is interest on capital, it will increase the partners' balances. Then, salaries and commission. If there is any salary and commission, will also increase partners' balance. Profits on realization. If there is a profit made by their partners, then it will also increase their accounts. If there is any revaluation and there is a gain, it will also increase their accounts. So this side, it means you have partners balances which are here being increased by these transactions. Yeah, because the partners are making these transactions with a partnership or with a business. Then what is going to reduce their accounts or their balances is put on the debt side. You have the drawings. If a partner draws uh, money from the partnership, then the drawing will reduce his amount in the business. Yeah. So, for example, if the partner had this, for example, had 4 million, yeah, in the business, and he has drawn 2 million, then obviously for him he has two. Interest on drawings. If there is also interest on drawings, interest will increase the drawing. If there is any loss made or revaluation or on realization, as we are going to see, it also reduces what the partner has in the business. Then at the end of the day, if we balance the account, then if the debit side is greater than the credit side, then it means the partners have a loss on their capital account. But if the credit side is bigger than the debit side, then obviously they have made a profit on their capital, on their current account. So a profit is put this side, profit shared, but a loss is put this side. Then balance carried forward. If their balance is at the end of the year, we put them here. So that is the current account. Let's look at the double entry records under partnership. Most important are the double entry uh, records. One, when additional capital is brought into a business, debit cash and credit partners capital account. That is individual accounts. So when money is brought into the business, debit bank or cash, then credit individual capital accounts. When the partners are entitled to interest on capital, then debit profit and loss proportions account, then credit individual partners current account. In case of a drawing, debit the individual partner's current account, as we said here, yeah, then then um, then credit bank. When the partners are charged interest on drawings, debit interest, debit individual current account, then credit P and L. So that. We have more entries. When the partners are entitled to salaries, the salary will um, reduce the profits of the business, but will increase the partners' balances, especially the current account. If especially we are using the fluctuating, whether fluctuating or not, because we say if we are using fluctuating method, then uh, the credit will be on the capital account. But if we are using the fixed balance method, then the credit of this one will go to the current account. Share of profits, debt, profit and loss, credit the individual partner's current account. That is when we are using fixed method. When you're using fixed method, then you use the capital account. Yeah. But if we are using the fluctuating, then you use the capital account because you have one account. For share of losses, that one. We have an example here. We have a good example here. Now, Paul and John are in partnership sharing profits and losses in the ratio of 6:4. The following is their trial balance for their ended 30th June 2001. So we have Paul and John, they are partners in the business. They have their balance sheet, they have their trial balance drawn at the end of the year, 30th June 2008. Yeah, 30th June 2008. Let's look at it. It has debit and credit. As usual, debit. In the debit, we put assets and expenses. In the credit, we put incomes, and the liabilities and capital. Yeah. So you have these new items. Current account. This is what you have not been seeing. You have current account. Yeah. You have credit balances. Current capital account. They also have credit balances. Drawings. They have debt balances because with drawings. Um, Drawings will affect capital. That's why they are in the debt, the debt column. Then additional information: closing inventory was valued at 54. Office expenses owing was 220. These are other additional information you would even see in other questions, especially for part 1. So we are required to prepare income statement and appropriations account, balance sheet, and draw up the capital and current accounts of the partners. Yeah. So that is that is an illustration for us to apply our entry. The our entries we have talked about. The next slide is on goodwill, but goodwill shall tackle it next time. But today we must first do the accounting. I mean the preparation of the income statement, the balance sheet using those entries. Okay, so let us go to the solution. Let's go to the solution. So remember, we are told prepare income statement and balance sheet, and the procedure here, you first prepare the income statement. The income statement: sales, less cost of sales, get gross profit, less operating expenses. Then after operating expenses, you get net profit. After net profit, you you put the appropriations. Yeah, you appropriate the net profit. Yes. Then after appropriations of net profit, then you prepare the the, the current account and capital account. Yeah. Then from there you go to the balance sheet. That is the procedure. But for the purposes of clarifying it very well and explaining it very well, I want us to first have a minute of a break of 1 minute. Then I first have a recording for this. Then we come back. Just a minute of one. Just 1 minute. Then we come back. Just 1 minute. Then we come